Bitcoin has just shattered its previous records, reaching an all-time high of $116,621.76 on July 11, 2025. This isn't just another price spike, it's a seismic event that's electrified global markets and captured the world's attention. Unlike past surges, this rally feels more mature, driven by institutional adoption and mainstream acceptance. Investors now see Bitcoin as a legitimate asset, not just a speculative gamble. The journey here has been turbulent, but Bitcoin's resilience is undeniable. This milestone reflects months of momentum, new investment products, shifting politics, and a growing sense that digital assets are here to stay. The big question now, is this the peak, or just the beginning of a new era for money and technology? The implications reach far beyond price charts, touching everything from personal finance to global commerce. The world is watching. What happens next could redefine the future of finance. At the core of Bitcoin's explosive rise is a massive surge in demand, one that's rewriting the rules of the financial world as we know it. Unlike previous cycles, this wave isn't just about hype or speculation, it's about a fundamental shift in who is participating and why. This time, the demand is coming from a broader, more sophisticated group of investors than ever before. From tech-savvy millennials to seasoned financial veterans, people from all walks of life are now exploring Bitcoin as a serious investment. Institutional money is pouring in at an unprecedented rate, with hedge funds, pension funds, and even major corporations seeking both growth and a hedge against economic uncertainty. These players bring not just capital but also credibility and long-term vision to the market. Bitcoin's dual identity as digital gold and a high-growth asset has never been more appealing. Investors are drawn to its scarcity, its resistance to inflation, and its potential for outsized returns, qualities that are especially attractive in today's unpredictable economic climate. The infrastructure supporting Bitcoin has matured dramatically. User-friendly apps, secure wallets, and regulated investment products have made buying, storing, and trading Bitcoin easier and safer than ever before, opening the doors to millions of new participants. This new level of accessibility has truly democratized the market, drawing in everyone from Wall Street professionals to everyday investors trading from their living rooms. The barriers to entry have fallen and participation is now global. The narrative has shifted dramatically, from skepticism and caution to strategic allocation. Today, Bitcoin is increasingly seen as a calculated, essential part of diversified portfolios, not just a speculative gamble. This isn't a fleeting trend or a passing craze, it's a structural change in how the world views digital assets. Governments, institutions, and individuals alike are recognizing Bitcoin's staying power and its role in the future of finance. The foundation for price growth is now stronger and more stable than in any previous cycle, built on real adoption, robust infrastructure, and a global shift in mindset. Demand is no longer just hype. It's a sign of Bitcoin's growing, undeniable role in the global economy and a signal that the digital asset era has truly arrived. Wall Street's embrace of spot Bitcoin ETFs has fundamentally transformed the landscape of the cryptocurrency market. What was once considered a niche, speculative asset has now been brought into the heart of mainstream finance, thanks to the introduction of these innovative investment vehicles. These regulated products allow everyday investors to gain exposure to Bitcoin through the same brokerage accounts they use for stocks and bonds. This means people no longer need to navigate complex crypto wallets or worry about private keys and security risks. The process is as simple as buying any other stock or ETF, removing both technical and regulatory barriers that previously kept many on the sidelines. Since their launch, Bitcoin ETFs have attracted a torrent of institutional capital. Pension funds, asset managers, endowments, and even insurance companies are now participating. This influx of large-scale investment has brought a new level of legitimacy and stability to the market, signaling that Bitcoin is no longer just for retail investors or tech enthusiasts. Every dollar invested in a Bitcoin ETF is backed by the purchase of real Bitcoin, creating relentless and sustained buying pressure. This mechanism ensures that the ETF's growth directly translates into increased demand for the underlying asset, which has a limited supply. The involvement of financial giants like BlackRock and Fidelity has further legitimized Bitcoin, shifting its image from a fringe experiment to a mainstream financial instrument. Their participation signals to the world that Bitcoin is here to stay. ETFs also offer a level of transparency and regulatory oversight that was previously missing in the crypto space. Investors and advisors now have the confidence to allocate serious capital, knowing that these products are subject to strict compliance and reporting standards. This has unlocked a massive stable channel of demand, fueling the current bull run and making Bitcoin's price movements more resilient and less prone to wild swings. The psychological impact is huge. Bitcoin is now seen as a credible, investable asset class by both individuals and institutions. This shift in perception is driving even more interest and participation. ETFs have effectively bridged the gap between the world of crypto and traditional finance, accelerating adoption and making it easier for everyone to participate in this new era of digital assets. This strong institutional foundation is a key driver behind Bitcoin's historic surge, setting the stage for even greater growth and acceptance in the years to come. Corporate America is making bold moves, adding Bitcoin to their treasuries as a strategic asset. These companies aren't just speculating, they're hedging against inflation and betting on the future of digital finance. When a major corporation buys Bitcoin, it removes supply from the market and sends a powerful signal to peers. This creates a domino effect. Each new corporate adopter encourages others to follow. For tech firms, it's about innovation. For others, it's smart diversification. Corporate adoption adds credibility and stability, reinforcing Bitcoin's role as a long-term asset. Some companies are even exploring operational uses like international payments and employee compensation. Each announcement strengthens Bitcoin's integration into the global economy. Corporate confidence is now a key pillar of this rally's sustainability. One of the most explosive forces behind Bitcoin's surge has been the short squeeze. As prices climbed, traders betting against Bitcoin were forced to buy back in, fueling the rally. When Bitcoin broke key resistance levels, waves of short sellers were liquidated, adding rocket fuel to the price. In just 24 hours, nearly $600 million in short positions were wiped out. This forced buying created a feedback loop, driving prices even higher. The short squeeze cleared out selling pressure, opening the door for new highs. It's a stark reminder. Fighting the trend in crypto can be catastrophic. While institutional demand set the stage, the short squeeze provided the fireworks. The result? A parabolic, record-breaking ascent that caught the world's attention. Betting against Bitcoin has never been riskier. Bitcoin's market is a constant battle between bulls and bears, each side fighting for dominance in a landscape defined by volatility and opportunity. Every day, millions of traders and investors around the world make decisions that tip the balance, creating a dynamic and ever-changing environment. Bulls buy, pushing prices up, bears sell or short, betting on a drop. This tug-of-war is the heartbeat of the market, with each side trying to outmaneuver the other. The actions of these traders set the stage for dramatic price swings and sudden reversals. Leverage turns this tug-of-war into a high-stakes game. Traders borrow to amplify gains but risk rapid losses. With leverage, even small price moves can have outsized effects, making the market more explosive and unpredictable. When prices move against leveraged positions, exchanges liquidate them to prevent bigger losses. This means traders can lose their entire position in seconds, as the exchange steps in to sell off assets and cover the borrowed funds. For short sellers, a rising price triggers forced buybacks, adding to upward momentum. As prices climb, shorts scramble to cover their positions, buying back Bitcoin at higher and higher prices, which only fuels the rally further. This is the engine behind a short squeeze. Each liquidation fuels the next, creating a cascade. The effect can be dramatic, with prices shooting up in a matter of minutes as wave after wave of liquidations hit the market. The recent rally saw steady buying from ETFs and corporations trigger wave after wave of short liquidations. Institutional investors with their deep pockets added fuel to the fire, making the squeeze even more intense. Each round of forced buying pushed prices higher, accelerating the surge. The market became a runaway train with momentum building on itself as more and more traders were forced to buy back in. It's a powerful feedback loop that explains Bitcoin's ferocious breakout. The combination of leverage, liquidations, and institutional buying created the perfect storm for a historic rally. The lesson: leverage can magnify gains, but in a bull run, it can also unleash unstoppable momentum. Traders must respect the risks, as the same forces that drive profits can quickly turn against them. In the end, the bulls decisively took control, rewriting the record books and reminding everyone just how wild and unpredictable the world of Bitcoin can be. Bitcoin's rally has lifted the entire crypto market, sparking renewed optimism and capital inflows. Altcoins are surging as investors diversify, fueling a broad-based recovery. The total crypto market cap has rebounded to $3.47 trillion, signaling robust growth. While still below the all-time high, there's room for further expansion if momentum continues. Bitcoin's leadership is clear. Its moves set the tone for thousands of digital assets. The rally has reignited interest in innovation across the ecosystem, from DeFi to NFTs. Bitcoin's strength is energizing the entire digital asset industry. A friendlier U.S. political climate is fueling market confidence. The return of Donald Trump and a pro-crypto administration has shifted the regulatory tone. Promises of lighter regulations and crypto-friendly appointments are boosting optimism. Upcoming legislative discussions signal a move toward clear, supportive rules for digital assets. Regulatory clarity encourages long-term investment and innovation. Investors are shrugging off macro concerns, betting on a pro-growth environment. This political tailwind is a major force behind the current rally. With Bitcoin holding above $116,000, the question is, what's next? Experts say the rally's drivers, institutional inflows, political support, and market mechanics, are far from spent. New price targets of $140,000 and beyond are gaining traction. The recent halving has tightened supply, while demand keeps rising. This classic squeeze, soaring demand, shrinking supply, sets the stage for further gains. Volatility will remain, but the foundation is stronger than ever. Institutional capital and regulatory clarity are fueling a more robust bull market. For many, today's record is just the start of Bitcoin's next chapter.